The lower of cost or market rule says that inventory must be reported at market value if the market value is lower than cost. This is the current replacement cost, not the sales price. So this is consistent with the conservatism principle. It can be applied three ways. One, separately to each individual item. Two, to major categories of assets. Or three, to the entire inventory. Generally, when this happens, it is because inventory has become obsolete in some way or damaged in some way, that the market value of it is no longer as good as it was when you purchased it. So then you can take the market value instead of the cost value. This is allowed even though it violates that historic cost principle where we record everything on our balance sheet at its historic cost. So we are able to, with this lower of cost or market rule, restate the value of our inventory. When we're looking at applying this rule, we have an example here. We have two types of inventory items, a Roadster and a Sprint. So we've done some assessment and we have its historic cost and its market cost. The Sprint has a higher market cost than the historic cost, but the Roadster has declined in value in the market. This allows us to reduce our the market value of our merchandise inventory by $30,000. So we take that amount down, we record the $30,000 to cost of goods sold, and we reduce the amount in our merchandise inventory by $30,000 to adjust our inventory cost to market. When we're looking at the income statement effects of inventory errors, we can see that if we have our ending inventory is understated, means we're carrying it on our balance sheet for less than we actually have in stock. We didn't do a physical inventory for some reason, or it's costed incorrectly, then our cost of goods sold is going to be overstated. Our net income will be understated, and in year two, that reverses itself. Now, most inventory effects will balance themselves out, as you can see here. If ending inventory is overstated, then in year one, cost of goods sold is going to be overstated, net income is going to be overstated, and then it's going to reverse itself out in year two. On the balance sheet, if we have understated our ending inventory, then our assets are going to be understated and our final equity will be understated. The opposite is true. If our ending inventory has an overstated amount, then our assets are overstated and our equity is overstated. We want to be as precise and true with our accounting information as humanly possible. Now we're going to look at some ratios that we can use to analyze how well a company is utilizing their inventory to make money. So the first one is the inventory turnover ratio. This shows how many times on average a company can turn over its inventory during a period. It shows us how well management is at controlling the amount of inventory available and how well we sell our inventory. So the inventory turnover ratio is cost of goods sold divided by average inventory. And average inventory is beginning inventory plus ending inventory divided by 2. The other ratio that we use is the day sales in inventory. This shows us how many days on average it takes for us to sell our inventory, or how long inventory sits on our shelves waiting to be sold. So this is our ending inventory divided by cost of goods sold times 365 days. We can see this example here then with Costco and Walmart. So we have inventory turnover of 11.9 times for Costco and it should say 8.3 times for the inventory turnover for Walmart. That means in an average year, Walmart sells out their entire inventory 8 times. And Costco sells out their entire inventory almost 12 times. The average day sales and inventory for Costco is 32.1 days, and for Walmart, 43.5 days. That means on average, now remember this is an average of every piece of inventory that Walmart and Costco has in stock, and that some days some inventory is only because they sell grocery items. Some inventory is going to sell much faster than other inventory, such as electronics or clothing or garden supplies, etc. So this is an average over all of their inventory. But on average, it takes 32 days for Costco to sell inventory and 43 days for Walmart to sell inventory. What we also want to look at when we're looking at ratio analysis is we want to look at several years next to each other. The general rule of thumb, we have 3 years here, but the general rule of thumb is to have at least 5 years worth of information about a company when we're doing a financial analysis of them. So what we can see is if there are patterns. Are they reducing? Are they staying steady? Are they increasing a lot or decreasing a lot? For example, if their norm was 45 days, as we see for Walmart, and then all of a sudden in the current year that had jumped to 50 or 55 days, we would have concerns about Walmart's operating cycle and their ability to sell inventory is decreasing throughout the year. We would want to follow up on that number to find out what's happening. But these numbers are pretty steady across 3 years with just a few changes. I don't see any concerns here that a financial analysis would want to analyze further. When we compare ourselves to similar businesses, that comparison is called benchmarking, where we look at other industries that sell things similar to us. So Costco, Walmart, we could also potentially put Target in here and do an analysis to see what those numbers look like. That is the end of chapter 5.